My name is Alex Wilson, and we have our guest, Ed Scott. And hi, Ed. How you doing?
Very well, thanks, Alex. How are you?
Good, good.
Great to be here.
So great. I'm excited to hear what you have to say. We've been talking now for a couple of months about investment opportunities in Manchester. Well, we have Manchester on here, but there are other opportunities: Manchester, Birmingham, London. But Manchester interests me the most. So we're going to discuss that today. But I want to get everyone in the investment mindset and tell people who I am. For those that don't know, my name is Alex Wilson, owner and broker of record at Remax Wealth Builders Real Estate. Started selling real estate in Toronto. Been selling real estate in Toronto for over 15 years. Number one Remax agent in Canada for individual transactions last year. Number 11 worldwide. And now I'm literally bringing you to worldwide opportunities. Inducted in the Remax Hall of Fame. Award of the Remax Lifetime Achievement Award at 35, Award of the Remax Circle of Legends Award. But what I'm most proud of, what you're all here about, is investment success. And that's where I've turned a $39,300 deposit into a $17 million real estate portfolio, which is 15 condos, a High Park triplex, and an apartment building in Hamilton. And when I first started off, I was investing in Toronto. Then I diversified in 2019, and that's when I started investing in Calgary. And now what I want to add to my portfolio is a diversification outside of Canada. I still believe in Canada. I'll still be investing in Canada, but I want some diversification in other countries. And Ed and I, again, been talking for a couple of months. And there are a lot of similarities to what we have to offer in Canada and England, and our economies are similar as well in regards to how they're structured. And obviously, our government is structured very similar because our government is based off the system in the UK. So there are a lot of attractive items there that are offered in the UK, and that's where we developed a mutual bond. So because I'm transparent, here's my portfolio, here's everything I own. And again, I do this because I want people to see the value of owning real estate over time, especially in where we are today in high interest rates. These are only a temporary circumstance. If you watched my webinar last week or a couple of weeks ago, where I talked about the 2 weeks ago, yeah, we're talking about how to profit off of the condo market downturn in Toronto. I was predicting interest rates will be 4%. The variable rate will be 4% by spring 2025. And that's where you have opportunity. If you invest now when rates are high and people are scared, you are going to profit off of that. And rates will come down. Even if you read in the paper, everything says that rates are going to come down. We are at the peak. The Canadian economy attracted 1.1%. That GDP that came out this morning. We are at the peak of the interest rate cycle. And what happens next is you have a rapid decrease in interest rates, and expect that to start happening next year into 2025. In 2025 is when you're going to see a big jump in real estate values. So if you look at things long term, none of that actually matters, because that it takes into, when you do things long term, your slope is going to even out, and it's just going to go up, and you don't have to worry about the peaks and valleys. So when I look at my real estate portfolio right now, it's worth over $17 million. But what's cool is that $17 million right now, there's mortgages on everything. But if I look in 30 years, which is the typical amortization period of a mortgage, that means all these properties are going to be paid off. And I didn't pay them off, a tenant paid them off. So now my portfolio is worth $42 million. And I will have that $42 million in the bank because a tenant has paid off those properties for me. And I've just calculated that at a 3% compounded interest rate. So nice, slow, and boring. So by taking a long-term approach on this, you can build substantial wealth by investing in real estate. But if you try to do things short-term, you can lose money. So if you try to do things short-term and you're entering into today's period, you'd be losing money in real estate. But you only lose money when you sell. So never put yourself in a situation where you have to sell. And what I want to show to people here is people may get daunted by the size of my portfolio, but you don't need a $17 million portfolio. If you just have a $1 million portfolio or a $2 million portfolio, which is very easily achievable, and you look again at that value over 30 years, and then if you want to pay yourself at a 5% rate of return on that portfolio, you can build your own pension fund. So let's say, for example, you had a $1 million real estate portfolio today. That, again, portfolio would be paid off in 30 years. And if we adjust for inflation, what does that mean with today's purchasing power? That's paid off. Pay yourself a 5% rate of return. You can pay yourself an income of $70,000 a year off of that. And if you wanted to do the generational wealth and just pay yourself a 3% rate of return, well, you can pay yourself $42,000 a year. You've built, and that's in today's purchasing power. You've built yourself a pension fund. That's exactly what a pension fund is. So instead of relying on someone else to control your future, you've taken your future and you've used real estate investment, which is you're investing into a roof over someone's head, and they're going to provide you money, and they pay down the real estate for you. And then you have this great portfolio you can live off of in the future. So now I have you in the investment mindset. We're going to buy, we're going to hold real estate over the long term. I want to show you why you should be looking at UK as an investment opportunity. So I'm going to share the floor with share our floor with Ed, our expert for the UK, and we can discuss why we should be looking at investing in the UK. So Ed, I'll let you do an introduction, and then you can share your screen, and the presentation ability is all yours.
Fantastic. Well, thank you very much, Alex. It's great to be here. It's great to have this opportunity. And yes, as you say, we're very aligned with our investment ethos, the long-term wealth creation through real estate. And thank you everyone for joining and taking the time out of your day to listen to me. Really, I'm hoping to give you some good insight into the UK real estate market, the benefits that can have for your portfolio and for your financial future. So what I'm going to do, I'm going to share my screen now, and we can get started. So without further ado, just a very brief introduction on me. So I'm from the UK, as you can probably tell, and as Alex said, I've been in helping international clients purchase UK real estate for over 15 years, worked for a major real estate firm in London doing that, moved to Canada, and over that time in the industry, I've sold over 1,200 properties, or helped clients purchase over 1,200 properties to a value of over $200 million. I've also helped clients purchase properties in 12 different countries around the world. So I've got good experience with working with different property systems and the advantages and disadvantages of each one. And we've worked with clients from over 54 different countries, which is one of my favorite parts of the job. The world is full of wonderful people, and we get to create really good long-term relationships. And that's the great thing about real estate, is the long-term trajectory of it. So when I moved to Canada, I realized that really there's nobody here necessarily providing the service to help Canadians purchase UK real estate, and it's relatively straightforward to do. So we wanted to fill that gap and be the connection to help Canadians purchase UK real estate, invest in UK real estate, and benefit from the rewards that come from it. Is that the UK is heavily invested in by nations all across the world, including Canada, and so this is an opportunity for Canadians to purchase assets of their own in the UK. I have some myself, have my own international portfolio of property in Canada and the UK, so I've been through it personally myself as well. So why should you invest in the UK? Well, there are a number of different reasons, but firstly, it's a very straightforward country to invest in for Canadians. There's no restrictions there. It's perfectly open. You've got the opportunity to do so. And it's a very proven market. It has proven returns from the UK real estate market throughout history. It's very mature. It's very secure. It's very transparent. It hits the top transparency index every year in the world, because you've got the secure legal system, a secure housing market, and it brings in a ton of international investment, very pro international investment. From your point of view, diversification, as Alex touched on, is a core component really of any balanced investment portfolio, because it doesn't leave you exposed to just one economy or one currency. It gives you the balance. If that economy or that currency isn't performing at the time that you need it, you have some security of having assets and income in another currency. You also then have the potential to gain from that other currency. So you can gain from the increase in the property value, the income the property produces, but potentially also the increase in the value of the pound if it does better than the Canadian dollar over time. So you give yourself the potential of extra gain, a bit more stability, a bit more security to your portfolio, and you can do it relatively affordably. You don't have to throw a ton of money in there. And Manchester, as I'll come on to, is one of those really affordable, exciting options. It also brings you some other opportunity. So for future generations, for yourself to have an asset, to have income in pounds, if you're going to go and travel, if you're going to go and live or study there, it gives those the flexibilities that purchasing, another property in Canada doesn't give. So you may not use them, but it's another advantage to it. And then you are not alone. Canada has been investing in the UK for a long, long time. It is the second most important destination for investment abroad from Canada, behind the US, of course, and vice versa. The UK has Canada as the second most. So there's a very long history of trade. It's a very open trade. They have the trade agreement. They have double taxation treaty, so that you're not going to get taxed twice. So it's a well-established relationship. Canadian pension funds, all those big names that you can possibly think of, have holdings in UK real estate. So it's set up, it's there, and it's ready to be done by private individuals too, and it is being done. So here are the advantages or the differences of UK real estate over Canadian real estate. So number one, in the UK, the tenant pays your property tax, which is called council tax in the UK. So it's the tenant's responsibility, not the landlord. So that's one cost that you wipe out, that you don't need to worry about with UK real estate. That helps improve your cash flow. Secondly, there's no rent control. So you can increase the rent with the market rate each year. So you can keep in line with inflation. You can keep boosting your cash flow as time goes on. And probably one of the most significant of it all is the ability to finance your properties as an international investor. You can borrow up to 75% of the property value in the UK. So you only need 25% down payment. And it is a very, very mature property market, very mature lending market. There are hundreds of lenders, and many of whom lend to international clients. And you can do it on an interest-only basis, so interest-only mortgages. And that does what it says on the tin. You just pay the interest on that mortgage. So you have no requirement to pay back the capital during the term of the mortgage. You just pay it back when you either sell the property or when you remortgage and the next bank gives you the same terms and the debt is passed on. So again, that helps you create positive cash flow fairly easily from a UK property. It also means it's easier to qualify for mortgages because the debt that you have to service is just interest. So it's a lot easier. You don't have to prove so much that you can afford it necessarily. And it allows you to take more mortgages as a result because you're taking on less debt each time with just your requirement to pay the interest and not pay back the capital. There are capital repayment mortgages like you have in Canada as well, should you choose to do that. But with interest-only mortgages, you're still benefiting from the whole growth of the property, the value of the increase in the value of the property. There's no downside to that. You buy a property for £100,000 and you borrow £75,000. That £75,000 is your total loan forever. You're just paying the interest on that. So all the growth when you sell it is all yours. So it allows you to create better cash flow, produce a passive income on top of your mortgage payments each year and on top of the growth. The rates in the UK are very similar to Canada right now. So you're not being penalized. You're not suddenly going to be paying much higher interest rates in the UK than you are in Canada right now as an international client. And as you become what they term an experienced landlord in the UK, i.e. once you've owned a property for more than a year, you then get access to even better rates. So potentially you can be getting better interest on your money, paying lower interest, I should say, in the UK than you would in Canada. And you can adopt the same strategy as Alex does and Alex recommends for your Canadian portfolio, whereby you put in one deposit. As that property grows in value, you can then remortgage that property at the higher value and take out the equity that you've built or the growth that you've built in there and use that as a deposit or a down payment on the next property and build your portfolio into the millions over time with just that one initial deposit. So you can simultaneously build a portfolio in the UK and in Canada using those one deposit in each country. You could even, if you wanted to, put in the deposit in 5 or 6 years' time when it grows in value, refinance, remortgage, take that deposit out, and you've still got the asset in the UK with being net capital zero in there because you've taken it out. So it gives you that potential. So that's why the UK, but where in the UK are you going to do that? Where are you going to make the most money? Currently, Manchester is top of the charts, and rightly so. It's one of the fastest growing cities in Europe. It's at the top of the big three that you would want to see as any real estate investor. Top of rental growth, top of rental demand, top of house price growth in the UK. So it is the #1 city for real estate investment in the UK. Second largest economic area in the UK behind London, and the largest UK airport outside London. So it is globally connected. London and Manchester, the two most globally connected cities in the UK and the two largest economies. But Manchester is a lot more affordable. And that airport also services Toronto. So you can fly directly Toronto to Manchester. It's the only other city other than London that you can fly directly to from Toronto. And it's where we say it's in the north of the UK, sorry, the north of England, and it's called the capital of the north because it's the major economy in the north region of the UK, but it's only 2 hours from London. So, and that's, covering most of England. It's not a huge distance away, but the value is really there. And you can have a look at the statistics there and what the city has created over time. It is full of innovation, full of disruptors, full of creativity, very, very energetic, exciting place to go and visit. If you haven't been, I definitely would recommend going if you get a chance. I go there every opportunity I get. Why is Manchester doing so well? Well, there's a number of different, very, very significant fundamentals. The first being the investment that is piling in, not only from the government, but from private and corporate centres. So London has always been the #1 city in the UK and always will be. And there's a very good investment case for London, and there's no trouble with that at all. But the government and private equity has seen the potential of Manchester. It's the second largest economy in the UK. And as I say, it's very globally connected. And so the government want to motivate that. They want to grow that economy to balance out the UK slightly, and to see the potential that that can add to the UK economy. And it is working a charm at the moment. They started this investment called the Northern Powerhouse, £250 billion of government money into the north of the north of England, of which Manchester is the primary beneficiary of it. They started that in 2014. It's running to 2036. We're just under halfway, about 9 years in. And during that time, the economy of Manchester has grown at twice the pace of London, purely from that stimulus, not only from the government, but also from private companies, private equity, as you'll see as the next slide. So now Manchester's economy is now a similar size or equivalent size to Vancouver. And there's a lot more growth to go. As I said, we're only not even halfway, and they're predicting another £37 billion of economic growth in just over 10 years' time. And with that comes jobs, and not just some jobs, but hundreds of thousands of jobs. And from the biggest companies in the world, they're looking at over 200,000 new jobs to be created in just over 10 years. You've got 80% of the 100 largest companies, the FTSE 100 companies in the UK with a presence in Manchester now. You can see all the stats there. One of the big ones is it's the fastest growing tech hub in Europe. So you've got huge tech hubs, tech companies in there, lots of venture capital going into growing that industry in Manchester. The government, as part of their initiative, have moved a load of government jobs there, and Tim Hortons is there. So Tim Hortons, in their wise choices, chose Manchester as their location to open up Tim Hortons in the UK, not London. They chose Manchester. They now have 9 stores, and it's a big success, and the Brits love Tim Hortons. And these companies are doing this, and they're attracted by this because it is a lot cheaper to run their business in Manchester than it is London.
And I want to add, and we've talked about this before in our Calgary presentations, and again, you and I talked about, Manchester's like your Calgary of the UK. The key thing is why these companies can open in Manchester these international companies and open offices there is, again, you have an international airport that you can fly direct into Manchester. You're not flying into London. You're flying direct. You can fly direct into Manchester, and that's the key thing. So any executives, if they're going in, they can just go directly to Manchester, and then they can do their operations on the ground. Something that we look at when we're looking at our investment markets is, can I get directly there from another place internationally? And yes, you can, but it's your affordable option. So what's going to drive people? And Ed will talk about that more, is London's really expensive, and London will be fine. London will always be there, but where's the affordability? Where's that young professional, if they want to have a lower cost of living, where are they going to live? But there's still opportunities for jobs. This is the opportunity where it is, and I'll let you continue. Just want to hammer down
and yeah, I couldn't agree more. And it's yeah, you've got 210 direct destinations from Manchester Airport. You go all over the world. We've got money coming in from all corners of the globe into Manchester, and that's really one of the big fuels of this growth. So, and then that comes on to, of course, the population growth, as you touched on there. You've got people immigrating to Manchester. You've got students in Manchester. You've got some movement from London to Manchester for the affordability of life. And so as a result of that, the population in Manchester is growing at twice the average of the UK. It is exploding with people. It is a lot more affordable for young people to live there. They can save for a deposit for a house. They have disposable income. They have all the culture and the gastronomy and all the excitement that's going on in a young, growing city. And one of the significant points is that Manchester has one of the largest student populations in Europe as a city. And it used to be that those students would get the great degrees and have a wonderful time at university, then wave goodbye and get on the train to London and go and get a job in London. And that is what happened for a long, long time. But that has changed now, because now in Manchester, you have 80% of the largest companies in the UK. You have the fastest growing tech hub in the UK. They don't need to go to London to get the job anymore. Some do, of course, still, and London will still be a very attractive place to live. But Manchester now is retaining over 50% of its graduates, 50% of those 100,000 students. They're retaining. That's a highly skilled young workforce that is driving that driving that city forward, and the country, in fact, but driving that city forward specifically. And a result of that, you get the highest rental demand in the UK. You can see there in the last 5 years, the demand has tripled. You now have any rental property you put on the market in Manchester, you get 30 inquiries through the door straight away. It is full, and they are just not building houses. They cannot keep up with the pace of the population movement. And then you see there the highest rental increase in the UK, almost 20% in 1 year versus the average. And the 99% occupancy rate, only the 1% is just people moving in and out. It's full. And that's a great sign for a property investor. And that brings you then on to property price growth, a big stat for real estate investors. How much is it growing? How much is it going to grow? Well, Manchester's number one for that as well. It's grown at 10% a year on average over the last 10 years. So 100% growth over 10 years. And you can see from that chart there, which is from Oxford Economics, that is the supply of housing going forwards, how much is in the pipeline to be built. And it's going to result in a deficit of 82,000 homes in just under 10 years, which is very significant. That keeps the supply demand very much in your favor. You've got this population movement, you've got these companies coming in, is going to support house price growth for a long time still. And as I said, we're only halfway through that government investment that's going on, let alone all the private investment. And even with that, you're still less than half the price of London. So in terms of affordable diversification and the growth path that is still left for Manchester is huge. Remember, Manchester is the second largest economy in the UK and the same size economy as Vancouver. So if you imagine that Vancouver prices were half the price of Toronto at that same level of economy, and the government was putting £250 billion in there, it would be an exciting proposition. And so then that is what we have in the UK right now. And so to give you an idea, over the last 10 years, the clients that bought with us, or any client that bought in Manchester 10 years ago, had they bought in cash, would have doubled their money right now, right? They would have just bought, and they would have doubled in value, gone up 100%. anyone who put in a 25% down payment there and borrowed the 75% interest on your mortgage, not only were they producing free cash flow, which is not factored in there, but you've amplified your return 4 times. So you use a 400% return over the last 10 years. So it's phenomenal returns, exceptional momentum. So I'm going to touch now on just a couple of opportunities of, we've got the UK, we've gone into Manchester. Where in Manchester are you going to make the money? Well, this is an example that I love. It is about the most affordable entry point for a high quality development in Manchester. It sits in Trafford, which is just south of the city centre, sits between Media City, one of the largest media hubs in Europe, the city centre, and then Old Trafford, the Manchester United football stadium, which is 10 minutes walk away, and Old Trafford Cricket Ground, which is the International Cricket Stadium. And in that little zone there is a 135-acre regeneration zone where millions and millions of pounds are going in to really connect those 3 centres. But the property value there is very affordable. So you can get involved at like, as the figures you can see there, 1 bedroom for the equivalent of around 360,000 Canadian. You've got just over a 2-year time horizon for completion. You're looking at 10% now, so 36,000 Canadian, 10% 6 months later, another 36,000. And at completion, you have the balance. But if you're taking the 75% mortgage, you just have 5% left, plus your closing costs. That's another 53,000. So if you look at the bottom table there, your annualized forecast. So the capital employed, that's 125,000 Canadian. That's the money you've put in over the construction there, split over 3 years essentially, or 2 years. Then that's the total amount you're putting in. That's your 25% down payment plus your closing costs, your purchase tax, solicitors fees, etc. That's the total amount of money that you are putting into this investment yourself. The average net income, that is the income you're producing after your mortgage payments, after your running costs, after everything else. That is your surplus free cash flow that you can do whatever you like with. On average, you're going to get $7,800 a year on top of the growth. And we've put in this forecast 5% annual growth over the next 10 years. Remember, it's growing at 10% for the last 10 years, and you've still got the huge momentum with it. So at 5%, your free cash flow plus your growth, you're looking at almost 25% return on your capital. If it grows at 10% and continues to grow at 10%, then it's going to be a lot more. And then this one is a prime city centre Manchester top opportunity. This is prime real estate right in the centre. You're right in the city centre, walking distance to the train station, 10 minutes walk to the financial district where you've got all those incredible companies. It's got the market leading amenities. You've got everything you can imagine. You've got swimming pool, spa, co-working space, gyms, restaurants, green space. It's a proper community, very, very high luxury living right in the city centre. That's prime real estate that's going to carry forwards for a very, very long time. To give you an idea, you buy £310,000 there for a 1 bedroom. If you were to buy that same property in the same location in London, that's going to cost you 1.2 to 1.5 million pounds. Just to give you an idea of the value that can be had for getting in now in right downtown in the city centre of Manchester. This one has a slightly longer time to completion, 2026. So you have got 3 years there. You can see the figures there of how much you put in at each milestone. And then the annualized forecast, again, you're slightly higher on this one because your yield or your cash flow is going to be slightly better, or it's forecast to be slightly better. 180,000 Canadian total split over 3 years. You've got that almost 12,000 net income, free cash flow plus your growth, around 25% total return on your money on average over a 10-year period annualized. And they're just 2 of the opportunities that we have in the UK. There are plenty of opportunities. There are other opportunities in Manchester. Birmingham also has a very good investment case. London, always number 1 in the world, expensive, but still there's a potential there. So we can help with any of those. And these are we offer the same service as Alex does in Canada. And this is why we're so well aligned and wanted to work together on this, is because when we set up Finlock Property, as I said, there was no real service there to help Canadians invest into UK real estate. And with our experience, we've built this system now whereby we work just for you. So we're not working on behalf of specific developers. We don't partner with any specific developers. We work just for you to get the best for you out of the UK market and diversify your portfolio to give you that security. So we can do it across the UK. But if you're looking for, the reason we're focusing on Manchester, if you're looking for affordable diversification, then Manchester is really the top choice right now. And we can arrange the full management of the property for you. So it's a passive ownership. We can raise the mortgage for you. We can make sure you do everything from home. So it's nice and easy. As I say, it's an open trading path with the UK. And we follow the same values, same qualities as Alex. It's a client-first approach. It's a long-term, sensible wealth creation through real estate. Our motto is: you invest in property, we invest in you, and that is exactly what we do. We stay with you throughout the whole process. We are there as your guides to get the best out of it for you, and we're doing the same for ourselves. And I just want to finish with this quote very quickly. It's my favorite Warren Buffett quote. Everyone has a favorite Warren Buffett quote, but someone's sitting in the shade today because someone planted a tree a long time ago. I think that just embodies everything about sensible financial planning, so sensible investment. And I think Manchester could be a very good tree. And there are my contact details. So happy to take any questions from you, Alex, or anybody else. Thank you very much for listening to me. I hope that was of value. And yeah, we're here to help.
So stop sharing your screen, and what we'll
Yep.
do is we'll open up the floor to questions. I do know we're getting some Q&A at the bottom. I'm just going to start off with a couple quick questions.
Yeah.
So first of all, objections that we get, or what people worry about, and I can see them in the Q&A box down below, but I'll just address them right off the top. So first of all, number one is someone getting a mortgage, and then touch on quickly the interest only mortgage as well. And I know Ed and I talked about this offline, because Canadians aren't used to interest only mortgages, which are prevalent in the UK. So talk about how the bank will give financing to someone here in Canada, and talk to them about the interest-only mortgage. We'll start with that one.
So because the UK property market is so well established and the lending market is so well established, they're very welcoming to international investment, and there are many lenders in the UK that will lend to international clients, specifically for investment property, because they take into account the income that the property is going to produce as part of the affordability and assessing the mortgage value. So it's less weighted on you as an individual and more as the investment proposal of the property almost, although you have to have some income and you have to be able to support it to a degree. But the reason that people use interest-only mortgages more so than capital repayment is purely for the cash flow point of view. You don't sacrifice the capital growth. You still have the option to pay back that capital as you want over time. You don't have to keep that loan, but it gives you the flexibility of having a better cash flow, still benefiting from the growth, and still having the option to pay back that capital over time if you want. And it helps you expand your portfolio easier because you have less debt to service, and it helps you afford more to start with because it's less complicated, less cumbersome on your finances.
And it allows you to generate positive cash flow, something that in Canada it's very, very difficult to do, to generate the positive cash flow. And that's where the banks, when they're lending, they're looking at the property. They actually look at the property, these residential properties in the UK, and there's a certain rate of return that they want on the property, and they're lending based on the property and you. Unlike here, where they're looking more at you, they're looking at, okay, this property, it's going to get rented out. This is how much income it's bringing in. I'm comfortable giving you a mortgage at a 75% loan to value. They're looking at the property. So that's how they're able to lend to people in Canada, because they're looking specifically at the investment property. They're not fully looking at your income. They're going to look at your income, but it's not driven solely by your income. It's driven by the return on the property. And because of these interest only mortgages, they will generate positive cash flow for you.
Correct. And I should say that actually that 75% that they will lend up to, that's the same for a UK client. So a UK resident, the maximum is 75% as well. So you're really getting exactly the same as a UK client, and so they assess it the same, and you're in the same position as I would be if I was still living in the UK.
Perfect. Now, number two, and I saw this right off the bat in the questions, I'm in Canada. How am I going to rent this unit out? How am I going to manage it? And this is why I chose to partner with Ed. This isn't just, hey, buy UK and forget about it. Ed's full service. He's got everything in place to rent your unit out and for it to manage. So why don't you just talk a little bit about renting and managing the unit after that? Because that is going to be number one, people are going to be scared. How am I going to borrow and get a mortgage? And number two, okay, once I got the mortgage, that's great. But how am I going to rent it out? And what if there's an issue with the property?
Yeah, absolutely. And that was really one of the main reasons that we created Finlock Property Investment is to create that full service offering to clients so that Canadians can do it without the worry, right? So we have management companies in the UK. It's very location specific, so we partner with specific ones in specific cities who are specialists. They will find the tenants for you, good quality tenants. So remember, you're buying good quality building, good location, you're going to get good quality tenants. They will manage the tenancy for you. They will manage the property for you. They will manage the maintenance for you. They will take care of it. They're your eyes and ears on the ground. They will look after everything for you. So you are simply the owner, and you watch the income come in. They will be the manager of your investment, the manager of your property. And so we do that. And we take care of everything that you could possibly need at any step of the search, purchase, ownership, and sale of the property. We're there every step. And we're designed specifically for international clients, and even more specifically for Canadians. So we have solicitors who are experienced in working with Canadian clients, so they know how Canadians are and what they can produce and all of these things. We have mortgage brokers who are experts in raising finance for Canadians. They know which banks are the best ones to go to. They know which packages are the best for Canadians to borrow. We have accountants, we have lawyers. We can set you up a UK bank account. We can set you up a UK company, whatever structure we want, and we can go through that. Every part of everything that you need, we are there to help you with, and we genuinely want to help. We want you to have the best possible experience because we want you to do it again. So the better that we can make it for you, the better it is long term. And I genuinely believe in the value of putting UK real estate into a portfolio. And so I do it myself, and I want everyone to have the best experience of doing so.
Okay, so now that we address those right off the bat, I think that'll help some of the questions, but I just wanted to get those right off the bat.
Sure.
Yeah. So again, if you were looking to sell, Ed would have the contacts to sell the property for you as well. Do I have to get an England bank account to buy something there?
So the answer there is no if you're buying cash, yes if you're buying with a mortgage. But it is very simple. I will give you the two banks that you want to do it with. There are online banks now, Wise, W-I-S-E, and Revolut. They are online banks that Canadians can set up within about 20 minutes online. You get a UK sort code, UK bank account. You can transfer money. It's also very good for foreign exchange, so you can transfer Canadian dollars. Wise actually were originally set up called TransferWise, and they shortened it to Wise, and they were a foreign exchange company. But now you can open up a UK bank account. I actually use Wise for our company, in fact, because it's so easy to transfer money between the countries, and you get that. So yes, you do need a UK bank account if you take a mortgage, but it's very easy to set up, and we can guide you through that. You can do it, as I say, in 20 minutes. Yeah.
And I think what the base of a lot of these questions are is, again, you're set up to guide people on how to do this. And I get this question too. Do they ever need to go there?
No.
There you go.
No. You can do everything from your own home. The worst thing you have to do is courier documents. So you have to get up to do that probably. But other than that, that's all you have to do. You can do it all from your own home. We have clients, as I say, from 54 different countries around the world. Many of them have never been to the UK, let alone seen the property that they've bought in person. But we can do video tours. I go there in person. I can do personally. We can do that, but we have our staff in the London office as well as here in the Toronto office, so we can service all of that. So you can get a very good feel for the property yourself, and you can do it all without ever setting foot in the UK if you don't want to.
Great question here, because again, the interest-only mortgages are new to people here.
Sure.
Is it a much higher interest rate on the interest-only mortgage?
No. So it's exactly the same. So most lenders will give you the option. In fact, some only do interest only, but most will do both. And you get exactly the same interest rate, whether you choose to repay the capital or not. and it's up to you. You can take the repayment mortgage and interest only. So no, there's no, it's not more expensive. No.
And I think again, I'll add it. It's more of a Canadian thing that we don't have them. It's just we have, again, if you look at it, we're more monopolistic in regards to, we have our five major banks, and there's still lenders beyond that, but we have our five major banks. The UK is different. You have a much larger financial base that you're dealing with, much larger institutions, and they can do different things.
Yeah, and it's competitive. It's competitive lending market. You know, like I say, there's over 100 lenders. So it's very important to have a good mortgage broker who can get the right package for you at the right time. But yes, it's very established, and over time, the interest-only mortgage has been the one that's prevailed, and so that is the one that's predominantly used by investors. But as I say, you don't have to. If you're comfortable doing the repayment, that's also possible.
I like this next comment. So I am going to make it, because I think it's something that you will get as an objection point sometimes. So it's always good to address this question. We had it in Calgary for years and years, and people are like, Calgary, why are you investing in that market? It's dead. So this is someone's comment. Isn't UK dead already? Why invest in a dying market?
That's a good question. I wonder what that's founded on. But no, I wouldn't say that at all. I mean, the growth path of the UK is very promising at the moment. If you look at the economic projections for the UK as a whole, it's very promising. Because of Brexit, we've had the opportunity now to create these new trade agreements. The free trade agreement with Canada, they've got the extended one that was in place from the EU, but the new one's coming into place. They're hoping to have it agreed by next summer. And this is going to open up a lot of potential for the UK now. They're not restricted by barriers now, and they're devolving within the UK as well. So even the local cities have more power to create trade agreements themselves. Manchester just did one with North Carolina for technology. So there is a lot of potential there. The UK has been a very industrious country, great international relations for a long time. London being one of the financial centers of the world. Yeah, I'm very passionate for it. I think there's a lot of potential there.
And when you look at it, and a lot of things when I describe Canada's safe and boring. So is the UK, except maybe not as boring. But when you're looking at, and you highlighted on the education factor of Manchester, and then retaining 50% of those graduates, the international population that comes to the UK, just like Canada, just like the US, is huge, because people in developing countries send their children to first world countries to get that higher level of education. And that's where so that's where you have a built-in pool that's always going to have people coming in, because they're going to be sending people to the UK just strictly for the education. And then when you have the companies that are setting up base, and this is also with when you factor in Brexit, when you set up those trade agreements, and then what you have, and now I'm getting macro, and Kyle's like, no, don't go down this road, but you have to, if you got to look out 10 years. So we look at Brexit and the breakaway between the UK and the European Union. Well, what's going to happen when you look at America? America is setting up its relationships with the UK, and then the UK becomes the guardian, like the entry point to get into the EU. It's going to be the UK, and that's what's going to happen. And that's where you have, when you have these major technology companies, where are they going to set up shop? They're going to be setting up shop into the UK. You're going to have massive investment in the UK, and that's where you have the international pool of students. So you have your institutions coming in, because again, the Americans are going to have strong trade relations with the UK. And then when you have these technology companies set up, then what are you going to want? You need the workers, and where are the workers going to come? Well, you need a strong education base. This is where you look at the infrastructure. You need a strong education base to feed the young workers. That's where they're going to set up, and that's where Manchester. So I'm getting a little macro in regards to 5-10 years out, but you got to look that way. The UK went through the pain of Brexit. Now they're getting on the other side of it. So again, you're buying at the bottom. Look at the upward trajectory.
That's it, and the UK just has some advantages in terms of its location. Is sort of, to do business, is a great place to do business, because it has one of the lowest corporate tax rates in the G20, and it's right in the middle of the globe. So to do business with all parts of the world is one of the reasons for its success, is that it's so well located for a central hub for business, international business, and obviously being English speaking, it's very easy for the rest of the world to get involved, and so it's very well positioned in that sense. And you have incredible, for the real estate market especially, you have incredible fundamentals that are ingrained there, they're not going anywhere. There's a 4.3 million household shortage in the UK currently. The government are not building enough houses, so they're just the core fundamentals of the UK as a whole. More people than there are properties, and more immigration coming in equals property price growth. And that at its core is the fundamental of real estate investing.
Ricky, a good investor of ours, he just pointed out, and I'll let you go into this because it's more than I know. Slide 11, capital employed should be Great British pounds of 100K, including 5% on top of close plus closing costs instead of Great British pounds of 72K. I get it.
I'll
let you go back to slide 11.
This is on which slide? Sorry,
so slide 11. He was saying.
Slide 11. So the GBP, £72,000 capital employed. Is that right?
It's saying capital employed should be 100 versus 72 because it includes the 5% top up at close plus closing costs instead of.
So the 72,750, it's 25% plus your 20 costs. So 25% of your 213 is 53, plus you've got £20,000 worth of costs. So that takes you to the 72,750.
All right. And yeah, Ricky, Ed can go over one-on-one, go over direct math and everything like that.
Yeah, and I can send you the spreadsheets with the formulas of how that's all
people play that with that stuff. Now, what does full property management services cost for that, and what's tenant turnover?
And what was the second part? Sorry.
Oh, and tenant turnover. What's your tenant turnover like?
Oh, right. Okay. So the cost is a good question. So generally speaking, the market average is 10% plus VAT. So it worked out 12% total for a full management service. That's finding the tenant, looking after it, and taking everything off your hands.
So in that 12%, does that include finding the tenant as well?
No, so there'll be a tenant finding fee on top of that.
Okay, just want to confirm.
£500, something like that, depending on the agency. And then the 12% is collecting the rent, managing, doing the maintenance. In London, it's more expensive. It's about 14%, but in the regional cities like Manchester, it's going to be 10%. The average tenancy in the UK is 2.5 years at the moment. One thing I didn't touch on, but it's another big point, is the increase in the rental population. So you've got the growing population, but you've also got a big percentage, a larger percentage of that population renting more than ever before. It used to be 1 in 10 households, now it's 1 in 5. So that's increasing the demand. And so that means people are staying in rental property for longer. So the standard lease is 12 months in the UK. So you would sign a 1-year lease with your tenant. At the end of that, they can renew, and generally 2.5 years is the average stay for a single tenant in property in the UK right now.
Great. Next steps, and Mal, just reach out to me, and I'll set up something with all of us to chat. And Mal's one of our top investors. Terry asking a good question here. Can you just go, what would the typical closing costs be on one of these condos? He's just asking, why are closing costs so high? You should see what the closing costs are in Toronto. They're higher than that. What are the closing costs again? Like, so let's say we're looking at, that average example of a 360, that's 360 Canadian. Just that first example you gave, what are the closing costs? Like, just breaking down on what it is.
Yeah, so you've essentially got 3 closing costs. You've got your solicitor's fees. That's going to be about £2,000 or so. For the solicitor's fees, you've got 4 costs if you're buying a mortgage. Then with the mortgage, you've got your mortgage broker fee and any bank fee that comes with the valuation, etc. So all of that's tied together. So that's going to be in the region of £3,500, something like that. You've got the cost of furnishing the property. So again, these are all variable. These are kind of estimated costs. So they're variable depending how much you want to spend on furniture. So furniture, somewhere between £3,500, something like that. And then the final closing cost is stamp duty, which is your purchase tax, like the land transfer tax. And so that's it all combined. They're all one-off costs, and so they're just the cost of purchasing a property in the UK, same for somebody in the UK or anybody else.
Which I saw the more detailed breakdown. We didn't go into the detailed breakdown on the slide, but
Yeah.
Ed and I have gone over the detailed breakdown
And
together.
I can share that on any of the proposals that we give. We give so you'll see
Yeah.
it all. This is just to give you a brief
Yeah,
idea.
yeah,
Go through the
we keep it
detailed
easy on here on our webinars because we don't
yeah,
want to get people too into the weeds. So yeah, there is a detailed sheet, and Ed will go over those specific costs with you and everything like that.
absolutely. Yeah.
Condo fees. What are the monthly condo fees typically like?
Okay, yeah. So condo fees in the UK are called the service charge, but it does
Mhm.
the same thing. It's for covering the communal cost of the building. Um, Again, they of course will vary depending on the facilities that are in the building and where the property is. So in London, service charges or condo fees are a lot more expensive than they are in Manchester, just because of the cost of servicing. Everything's more expensive. So in Manchester, if you're looking at so that first property that we saw, the sort of the affordable entry level in Trafford, there you're looking at a service charge about £2 to £2.50 per square foot. Not square meter, but square foot, for a building like that. For the one in the center, where you have all of those facilities, it's going to be in the region of about £4.50 per square foot. And that's all factored into that net cash flow in those figures that we put there. And again, I can show the breakdown.
Yeah.
And that's
Yeah, yeah. Again, all of these property examples do cash flow with 25% down. And I wonder too, where people are looking at the closing costs, on that line, part of that is 5% down.
yeah. So
So
maybe
that's
maybe
probably, I
that's
wonder if that's where people are getting
that
confused.
might be the
So
confusion.
so
Yeah.
your closing costs aren't 70 some thousand. I think they were just like 20 some thousand. Uh, but that 70 number was plus your additional 5% down on closing,
That's right.
which
Yeah.
is 53. So that's
Sorry.
equity in
Yeah.
the property. You're just putting more down. It's not a closing cost. That's not actually a cost. So your closing costs are just 20 some thousand. That 53 is additional down payment to bring you up to the 25% down payment. So again, in the UK, you're looking at a 75% loan to value. So any property you're buying on closing, you're going to have to put 25% down.
Yeah.
Here in Canada, it's 20% down. There it's 25% down. So I think that might be the confusion, people looking at the number. No, a lot of that, the majority of that number you're looking at closing is just that additional 5% down you're going to have to come up with closing. Yeah. On average, what is the exit cost to dispose of property? So because I had this question somewhere else too, like what are typical real estate commissions to sell a property?
So if you use a local estate agent on the ground, it varies depending on the value of the property. But say in Manchester, generally they're going to charge between 1.5% and 2% of the property price. That's going to be your agent fee for selling it, and then you've got solicitors' fees again, 1,000, 2,000 for that. That would be it. Yeah.
And I'll add over there it is different. So here it is, you're looking at 5%, but that's because here the seller pays the buyer agent commission. That's why it's 1% to 2% there. They have a different real estate model. If you were a buyer in Europe, really, but we're in England, you would pay your agent. If you were a buyer using an agent, you're paying that person directly out of pocket. So it's a different model out there. So your exit costs, as I was saying, you're looking at 1% to 2%. Estate agent fees, that's what they're called out there, estate agents, and then plus your solicitor fees as well. Right. Does the client pay for your service directly? I think that would come a deduction of rate directly from the rent, right?
Our service, Finlock Property. For us, we don't charge.
Oh no, yeah, there's no
We don't charge any fees. We'd always get the fee from the seller. We're not linked to any particular sellers, but any properties we sell, we will always take the fee from the seller, not from the client. So we essentially don't cost anything to our clients.
Yeah. Good question. Airbnb, is it allowed in the UK, and can you do it in Manchester?
Yes. Well, yes and no. So in Manchester, yes, it is allowed, and yes, it happens. In terms of a kind of jurisdiction area, there's no restrictions on it. However, the buildings themselves will often have restrictions. So you have to be permitted to do short-term letting within the buildings, and buildings that generally have concierge services, lots of facilities, generally don't allow it, because it just becomes a nightmare with the transition of tenancies the whole time. And what they want to do, most of these developers or the what I would say the sensible ones, they want to build communities in these buildings. They don't want these transient in and out building that's constantly turning over all the time. You want to build, the average tenancy is 2.5 years in the UK. You want to get people in there who are going to build a life, build a community, and it's much healthier for the building, much healthier for the community around. So, but there are options. And occasionally it can be negotiated with the developer. So that one next to Manchester United Stadium, that one, the developer will allow it on a case-by-case basis. So there is the potential there, and we can do forecasts based on short-term letting, and we do have management companies that will do the fully manage the short-term letting side of it for you as well. In London, there is a restriction short-term letting. So within the Greater London area, sort of, if you know London, sort of the M25 that runs around is more or less the Greater London area. Within there, you can only short-term let a property for a maximum of 90 days in any calendar year. So it's possible, but it's not really an investment model in London anymore. Some people will still do it and try and get away with it, but and again, most of the buildings, the big nice towers, won't allow it anyway. There are some options, and we do have some options where you can do it. And you can look at the commuter belt area around London. There's some good short-term letting markets where you can benefit from it as well, but they are probably going to be more income focused than they are growth focused in those kinds of areas. So again, we can help with that if it's something you're interested in to do. Yeah.
Can you get pre-qualified for future closings?
A mortgage offer in the UK lasts for 6 months. So, but when you get close to the completion of the property, you're going to get your mortgage offer sort of in the 6 months run up to the completion of the property. If you do it before then, you have to keep renewing it. It's going to keep costing you, and the terms are going to keep changing. There's not really much point. You can get pre-qualified in the sense that a bank can say, based on your profile now, if it's the same at completion, then yes, we'll give you a mortgage. But you're not going to get anything more substantial than that.
Okay, perfect.
If it's more than 6 months away from completion. Yeah.
Good to understand. Do you deal with pre-construction or resale as well? Now, I'll just jump in. I said to Ed, our clients like longer closings. There are options with the builders that you have stuff that's going to close immediately right now as well. So there is a bunch of different product types. Just again, to keep it easy, I just said, let's focus on the stuff with the longer closing because our clients like longer closings.
Yeah, absolutely. But we have the range of just about everything. So we have some that are completed that have tenants in them that you can just pick up and go straight away. We have some that are 3 or 4 months away from completion, and you've got the longer completion ones where you can spread the money out over time. So yes, we've got the full range. Yeah.
Do you need the unit to be furnished or not? Ed and I did discuss this prior. It's more common out over there to have furnished because again, if you in North America, like Canada and the US, we're big countries, right? Whereas Europe's small. So you may have someone coming again, the average tenancy 2.5 years, but they're not bringing furniture with them. There's not that moving of furniture as much. So having furnished rentals are more common out there than it is out here because just the nature of the infrastructure that's set up in the UK. So yes, you can do without furniture, but then your numbers probably won't cash flow. And I'll let Ed jump in a little bit more, but I did ask this question myself.
Yes, I think unfurnished letting, so not furnishing the property, definitely exists. It's definitely a market. It is generally more advisable to furnish the property because the extra rent you get from the furnishing property versus the cost of the furniture, the return on that is about 20% because of the extra rent that you get from it. So generally from a financial perspective or investment perspective, it makes most sense. If you're buying a 1 or 2 bedroom in a city center location, definitely there's a much greater demand for furnished letting than unfurnished. But unfurnished letting is not a bad way to invest. Definitely the market exists. It's a smaller market. You have less upfront costs at the time, at the beginning. So there is a benefit to it. But your ultimate return on investment, if you're looking pure cash on cash, will do better with a furnished property. There are other markets, so like the commuter belt areas around London, things like that. There's much more established unfurnished letting market than right in the city centre. So it varies, but generally I would say furnished is overall better.
And we'll just finish off with these last two questions because everyone's been gracious with their time. And we're coming up on in the hour. So, but Dennis, another strong investor of ours, how much are monthly utilities and are they covered by the tenant?
Good
And
question.
and then some tax questions as well. I would say tax. You have the tax authority individuals that can help. But he just went on to say, and there was another tax question earlier. I just didn't touch on it. Also, what are the average personal tax rates for international buyers? Lastly, do international owners have equal property rights as UK citizens?
So, okay, I'll do one at a time. So in terms of the utility bills, etc., yeah, that's all the cost of the tenant. Essentially, your only costs as the owner or as the landlord are the service charge, which is your condo fees, the fee you pay to the management company for running it, and then any potential maintenance going on. There's no other cost than that. So you have those sort of three costs. And with these new builds, the maintenance should be pretty minimal. You've got a 10-year new build warranty from the developer, so nothing on the structure, etc., is ever going to be your issue for the first 10 years. And then, so you're only responsible for maintaining the interior of your apartment, and all the new appliances, etc., are all going to have their own warranty. So very, very minimal from that point of view. So that's it for there. With regard, sorry, what was the next one?
Oh, just taxes. Like, what are the
Taxes.
average
Yeah.
personal tax rates for international buyers? And then, do international owners have equal property rights as UK citizens?
So equal property rights, yes. Exactly the same, no difference there. You get the full title deeds, it's your legal ownership. You're treated just like a UK resident. In terms of tax, so Canadians are taxed on their worldwide income. So you get taxed essentially at the same rate as you would by buying if you bought a Canadian property. You're going to get the same level of income tax. You can, of course, buy the property in a UK limited company and shelter it like that, in which case the money you put in when you pay it back can be a shareholder's loan, and you're just paying the corporation tax, which is 19% in the UK there. And you can grow that portfolio within the UK limited company should you wish. Some prefer to, some prefer not. It's entirely a personal decision. We can help with that, and we have advisors as well that can give you guidance on your specific situation.
And then finally, the last question we're going to deal with here is how do lenders in the UK estimate rental income on pre-sales?
So they don't is the answer. So because you're only going to get your mortgage sort of within 6 months of the completion, when you get that, when you do your mortgage application, they send a valuer around to the property to value the property and value the rental income of the property. So it's whatever the bank's valuer deems the value of the property to be, and the rental value of the property to be is how they will estimate it when they give you your mortgage. You don't have much to say, and it is their estimate of
Yep.
what they feel the value is. Yeah.
And I'll just answer the last two parts here of Dennis's question. Average market rental rates in the area. Ed can share you those with those if you're interested in more. Because again, it's gonna if you, the one building which is kind of outside of the core, that's gonna have different rental rates than the building downtown. There is no assignment market, I would say, in the UK. If you're buying this plan to close on this property, is that correct, Ed? Would you say?
Yeah, it does exist, but it's a tiny market, and most developers don't have that clause in there. Some do if you really want it. It's something that I'm pretty sure can be negotiated on a case by case, but it's not an established market. But it does happen. So I would never advise it as a strategy, but more as a kind of backup. If for some reason you feel like you're not going to be able to close, you've got some exit, then yes. But as a strategy, it wouldn't be something I generally advise. But if that's what you want to do, we're more than happy to help you and put you in the right options that do have that opportunity here.
And I'm going to do this. I did say the last question, but this is my bonus last question because it's actually a good question. We didn't address it because it's something we experience here in Canada. There are no extra taxes for foreign buyers on the buying side or on the selling side, correct?
In terms of yes, there's no you pay stamp duty just like you pay a slightly higher rate of stamp duty of purchase tax than a UK resident, which is 2% more. So you do pay slightly higher as a foreign investor. Any foreign investor would do. That's the UK government legislation at the moment. But other than that, no, everything else is the same. Yeah.
Perfect. Great. Well, thank you everyone for coming in online. This has all been recorded. So you're going to get a recap of this. If you have any questions, you'll be able to reply to that email, book a call with us. We do have some interested parties, just I saw via the chat and questions. But thank you everyone for coming in online. Our countries share a lot of similarities with each other, which that's why I think it's a great option to to do some diversification in with your real estate portfolio. So Ed, thank you for your time. Everyone for coming on. Thank you for your time, and
No
we'll talk
problem.
to you
Yeah,
all
thank
soon.
you.
Okay.
Yeah,
See
thanks
you.
everyone. Thanks for joining us. Yeah,
Bye.
take care.